Good morning, good afternoon, good evening, folks. Michael Zuber, one rinse at a time. And yes, she's back. Anna Kelly. How you doing, Anna?
I'm doing great. Great to be back with you as always.
Thank you for that. Yeah, I've been waiting to have this conversation with you. You and I have similar trajectories, experience. And I got to tell you, I think we could have a recession in the very short order. Certainly, again, recession being 2 quarters of negative GDP growth. I think that could happen inside the next 6 quarters and potentially start here in Q1.
Yes.
And this recession might be a nasty one, meaning longer. It's not going to be a snapback V-shaped recovery like 2020. It'll be longer, maybe not as long as a Great Recession, but it'll be a long one. So wanted to talk about that, what that might mean for the average person, what that might mean for us, because it could mean bad or good things for us as well. So happy to take this conversation anywhere you want to go. But yeah, I don't feel good. I don't feel good about our economy.
Yeah. Michael, I know we've talked about this a little bit, and the pandemic kind of threw everybody for a loop. It didn't work out the way any of us, thought it might. But we were already, based on a lot of different key indicators, yield curve changes, et cetera, probably heading toward recession by the end of 2019, early 2020 anyway. Yes. Where everybody in the news media said, oh, we're just doing amazing. There were a lot of underlying things that were showing there was some pain ahead. And we were already in the longest expansion period since Abraham Lincoln was in office. So, economies going in expansions when they're growing and contractions when they're coming down, right? So there's always these cycles of, the high of the high, the low of the low. And we knew that we might be heading that way. Then the pandemic came in, and I thought for sure, I think we were all saying the sky's going to fall.
Right.
We're toast for a little while. We got to weather it. Well, the government pulled out all stops and pumped a ton of money into the system to keep it propped up, to corporate, in the bond market, to not really to landlords, other than, in a backwards way, but to, the average population, and gave us a significant amount of money to spend. Why? Because if we didn't keep spending and we didn't keep borrowing to keep things going, we would have gone into at least a recession, if not a depression. So what my fear had been, and we talked about this a little bit early on, is now that the government's printing all this money, it always leads to inflation. Yeah, always. If you look at the history of the United States and you look at the history of other countries, when they start feeling rumblings, they basically try to stimulate the economy by giving money and then buying debt, right? And so essentially that's what they did. And we all said, this is going to kick the can down the road and eventually someone's going to pay for it. I don't think maybe not a lot of other people I talked to, thought the inflation would happen so quickly. But when you combined, the supply chain issues with spending, we are now in a period of mass inflation. So the government is kind of in this position that, do we raise rates? Well, they have to. It's one of the only tools in their tool belt. So they want to raise rates. And what that's going to do is slow demand because things get more expensive to buy, and kind of the fun time of spending is over. What in my studies in the past, what always happens after inflation and after rates start rising is that we go into recession, because it kind of swings the other way. And the balance that the Fed is trying to get right is, how do we slow things down, bring inflation down without totally crashing the economy? And I don't know that they know how to do it without totally crashing the economy. So I think there's pain ahead. I would bet a lot of money that we're heading to a recession, which is why it's really important to think about recession resilient investing right now. And how can you protect yourself, make asset preservation number one. Yeah. Cash flow number 2 to continue to be able to pay for things. And that shooting for growth and appreciation for me is number 3. It's the last thing I'm really banking on, because I think over the next couple of years, a recession, even though it may be only 2 quarters, they usually last 18 to 24 months. Yeah. And because of the headwinds that we're, pushing this into recession, I wouldn't be surprised if it lasts longer than that 2-year average before we even start to recover.
Yeah, you've got to pay for this eventually, right? There's been too much cash in the system for too long. The bills come due, the party's over. And the only way to really beat inflation, we haven't seen this since the early 80s and really with the decade of the 70s, you have to get rates up. But what the real challenge I have is what Paul Volcker did is he got the short-term rate above inflation. Can you imagine what would happen if Powell got the interest rate up just to inflation, let alone above it? You know, let's just say there's 2 points of supply chain nonsense. So instead of 7, it's 5. Can you imagine the front end at 5? I can't. That hurts my head. All the debt structures blow up at that. So the only other answer is you get it to some point and it's just paying for, like you say, 8 quarters, not 4.
Right.
Because you gotta pay somehow.
Right. And part of the other thing that worries me a little bit, right? And not to the point that I'm not investing. Obviously, I'm still investing, but I'm saying, what can I invest in and diversify? I think right now diversification is extremely important, right? Because we don't know what things are going to kind of fall out for a while. And you've got to have the wherewithal as an investor right now to invest for the long term. If you're doing anything now, hoping that in a year or two, you're going to make a lot of money and appreciation, you could get really hurt. So, we advocate invest for the long term, buy a property, hold on to it, and weather those storms. But one of the things that really makes me nervous, Michael, is that not only are we dealing with US economic issues, right? But we're also dealing with international issues, international economic pain. But in addition to the international economic pain of many countries going through the same thing, trying to pull out of post-pandemic spending, and needing to raise taxes significantly, is now you've got threats of war by 2 superpowers, at least historical superpowers, China on Taiwan and Russia on the Ukraine at the exact same time. And when a country like ours that historically has come to help bail out these things and try to be a peacemaker, already has financial problems, we can't really afford to fund increased military might to help these countries avoid disaster. And I've been thinking a lot about that over the last couple of years, but I recently started reading, and I haven't finished, Ray Dalio's new book on, basically changes in world order. And what he showed was history shows that for hundreds and hundreds of years, when empires rise and they start to fall, it all follows a very common trajectory of coming out of depression, creating a new monetary system, new fiscal policy, promotes all this growth. You get to the top, and then it kind of starts to collapse because there's overspending and too much debt. Things start to come down. They start to raise rates. And if there's internal fighting, because what happens is there becomes a wealth gap between the haves and the have-nots, the political elites and the common person.
Yep.
And right now in our country, we have political infighting, a strong wealth gap, lots of internal chaos, and we've got external countries fighting. Historically, when that happens and a country is failing financially, and now they've got to deal with the cost, political and financial, of internal and external fighting, if war happens, real war, it usually destroys a country's economic system, and then they start over and they reset it. And it seems like the US could be on that path, so how bad it gets and how quickly, I have no idea. Are there ways that the country can pull out of it and not follow the trend of what every fallen empire has gone down? I hope so, right? I'm still hopeful. I'm not a fatalist. But I do believe that with all the internal conflict, external conflict, where we are, in monetary policy, we're probably up for some years of worse pain than most people want to talk about, if I had to guess.
No, I think I'm right there with you. And again, just on this front, bear markets, now that's obviously a stock market term, but bear markets traditionally are kicked off by one of 2 things. One is an interest rate cycle of hiking. Shocking. The other one, the onset of war. I can't imagine what would happen if both happened at the same time. That would be not fun. The other thing we should talk about, just acknowledge, right? We're landlords, and a recession may not be good for rents or rent collection or any of that. So I think we should acknowledge that. I've invested through recessions in the past. Traditionally speaking, yes, there are some unemployment and all of that, but generally speaking, rentals go up because actually what happens is housing demand and purchases fall. People see renting as a better option, but curious what you've seen.
Yes, I agree. And, part of when the economy crashed in 2008, Where I lost was in the stock market and my company and my husband's small business. Where we did really well was our apartments, because again, people needed a place to live, and they still paid. And now that we've seen what the government's willing to do to protect the tenant and to come up with programs, as long as they can kick the can down the road, they'll continue to, implement those programs. But investing in areas where the people aren't hit the hardest is really what's going to make you the most resilient. Nicer areas, at least with good schools. It doesn't have to be the super nice property. It can be a Class C, poorer neighborhood in that area. But as long as there's good schools and low crime, people will stay and they'll continue to pay rent or be able to get assistance. One of the things that I think about, and I've really changed my tune from 2009, through the pandemic to now, is that I need to hold a lot more cash. Part of how we weathered the pandemic and the eviction moratorium was we just had to fund expenses from operations, even though we weren't collecting all the rents for a while. And eventually they got caught up, and we did really well because we were investing in slightly above average income areas that were faithful to eventually pay. But if I didn't have that cash, we could have been in big trouble with thousands of units, right? We didn't quite have thousands, but more than 1,000. And so now the conundrum is this: inflation is eating away at our cash. So we don't want to hold cash. But if a recession's coming, we need cash to weather the storm. So there's this balance of what do we do, and so for me, it's diversification. I've got lots of apartments, so I have more risk there, but at least in the past, it's been very recession resilient to be in apartments and to own, rental housing. Now I'm adding some vacation rentals because legislative risk, it's another thing to talk about. Yeah. If things get really bad, the government wants to protect the poorer people, right? So they could implement rent caps. They're talking about it all over the country legislatively. If they implement rent caps and your costs keep going up, you're in trouble. So I'm going after some vacation rentals that the government's not going to go after rent caps on vacation rentals. And in recessions, people still travel to mountains, lakes, and water because it's cheaper vacations. Yeah. So it's kind of a way to hedge a little bit and diversify in case a recession comes. The values of those those vacation rentals will come down in the recession, but I'm not worried about it because I'm holding it long term. I'm just hoping I can depend on the income. And you might think about some gold and some silver that do really well during, poor times, and being in more than one area as an investor. Yes, start in your backyard, but maybe you buy some things that are in a couple of other states just to give you a little bit of diversification as well, where there's a lot of demand for housing and limited supply. Yeah. So those are kind of the things that I'm thinking through, because I do believe a recession, and a painful one, is ahead.
Fun stuff. Well, episode number 3 is going to be how we take advantage of this. But episode number 2, I agree. I don't think it will be a deep one, but it's gonna be a long one. Depends on what happens with China and Russia. Oh yeah. In terms of how deep we go. Correct. So again, it's hard not to be fatalistic, but we just have to say we're not going to stop doing what we're doing, because how many of us have predicted that it would get worse multiple times and it didn't, right? Oh, yeah, for sure. So you don't want to lose out on continuing to build wealth. If we hit a recession, you want to make sure you have assets and you have cash flow. So I'm bullish on being an investor for the long term. I'm just preparing for the reality that we're probably in for a couple of years of pain. Yeah. Well, folks, you're going to want to stay tuned for episode number 3. That's where we talk about how we take advantage of this, or where the best opportunities come from. But before we do that, Anna, how can people find you? Great. You can find me here every week. You can follow me on social, Anna Kelly REI Mom. My website is reimom.com. And if you're interested in large apartment investing and you're an accredited investor, you can follow me at greaterpurposecapital.com. Thanks, Anna. Thank you.